Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project Podcast. I'm your host, Steve Quiros with Tri-City Equity Group. Today, we have Heather Dreves on the show. Heather is the Director of Funding at Secured Investment Corporation and Fund Manager with one of the fastest growing companies in the private money marketplace in the U.S. They're focused on residential real estate investments. Heather's passionate about helping self-employed entrepreneurs and their families build wealth and succeed in their business ventures and helping other investors deploy capital. She's looking for a high-yielding passive investment backed by residential real estate. A lot of our listeners know real estate can be very hands-on and very active. So sometimes that just gets super stressful and you just want something passive. So Heather's going to definitely guide us on how she can help us to get that done. All right, Heather, welcome to the show.
Yeah, thanks for having me. I'm excited to be here.
Yeah, absolutely. No, glad to have you on. Those of our audience that may not be familiar with you, kind of who you are. Tell us a little bit. How did you get started? How's your investing journey been, and how did you get to where you are now, managing a fund?
That's taken the clock back a little bit here. So I've been in the industry almost 20 years, which is just hard to believe. It's been a fast and furious ride, and honestly, kind of fell into it by chance. Had a colleague that I had previously worked with that was in the private money industry, had zero knowledge of what private money was. I always was under the assumption and understanding that if you were going to buy a piece of real estate, whether it was something you were living in or an investment property, you went to your banker. And if you were going to invest money, you went to your financial advisor. So my path started out as going to college to be a teacher. And my kids can attest, I would have been a terrible teacher. I have zero patience. So actually had a friend that was in the private money industry. He had, encouraged me to come work for him. And the rest is kind of history. I did everything from originate to servicing accounts, essentially kind of segued into getting my securities license because we sold notes, which is first lien paper. And at that time, we were selling fractional interest in notes. And so we were required by the state of Washington to have a securities license. So really saw that as an opportunity for me to really grow my knowledge of the investment side of things and obtained my securities license and really kind of just landed where I had this passion to help investors. And I saw, the opportunity that we were allowing these clients that had, some of them were just getting started investing. A lot of them had a nest egg, that they had saved up. And instead of, dipping into this nest egg and really just depleting those resources as they hit their retirement age or, stopped working, or even were just looking to, create additional cash flow. I saw the opportunity in how we were giving them the ability to live off of the earnings and not ever touch their nest egg. And saw this world outside of your traditional stock market, CDs, bonds, and things like that. I really, I'm a people person. I like relationships. I feel like this industry is a very relationship-driven industry, whether, you're an active investor or passive. And so just really took a passion to working with those types of clients. And the rest is history. I'm still doing that. And I see how these clients are, replacing their income, living the lifestyle that they've come accustomed to and not ever touching their nest egg, and also creating generational wealth, because they're not depleting these nest eggs they've saved up to. They're now leaving these legacies for their kids and their family, and also educating their kids. So I feel lucky. It was eye-opening for me. I also took advantage of the opportunity to start buying real estate myself. But I will say that I have fixed and flipped, and we currently own rentals, and I would much rather get mailbox money and not have tenants calling me in the middle of the night telling me their toilets are plugged up than being active. So I think it's just been this process and this journey for me. And, now I see, I've always seen what my investors have been able to do, but now that I'm in that position to start doing that, I see the opportunity and really, the ability to, create more cash flow for myself and my husband as we get, we're over 50 and getting to that age where we're starting to talk about what that looks like in maybe 10 years. But also teaching our kids like how to create wealth outside of your day-to-day job and, things like that. So I know that was a long answer to your question, but my journey has been long, and here I am.
No, that's perfect. No, that's perfect. And that gives us some great insight too. And too, like, I think it's really important. A recent episode I did was with some younger investors. They're kind of just starting out. They've been doing it for a few years. But, they get started in wholesaling and flipping. And it's like, I think it's always super important to see kind of the investing journey, because like that, you do want, okay, great. Yeah, everybody's got to start somewhere. That's great. But it's always great to have kind of a long-term vision for what you want to do. And to me, I've got a family, I've got, kids. And for us, it is about leaving generational wealth. And, after a while, the active, sources of income, let's say through real estate specifically, because there's a million and one different ways to make money in real estate. They can still be a job. It's like, well, you're not working a 9 to 5, but it is still, you have to be actively involved. And so, even for me, there are syndications. I mean, eventually I'm just an LP, I've just got my money, and just like how you said, it's mailbox money. I don't want to think about it. I don't want to have to, work and scrap and claw for every last dollar. I just need my money working for me. Yeah. So I think it's always important for people, especially our, investors, keep in mind, like, hey, long term, like start planting those seeds, like start letting your money earn for you. Yeah. But not enough people I don't think that they think about that typically early on. So, kudos to you for making the transition. And, so like the last couple of years have been pretty interesting, real estate, COVID, and, obviously now we're rolling to kind of a risk off, high interest rate kind of environment. How do you see, how's that been impacting you guys' business? What kind of changes have you seen in the industry, or, even with your avatar, your investor?
Well, I think one of the important things to understand about, and specifically about our real estate funds, which is really where I'm most active within our organization, is raising capital and investor relations, is we have developed these funds, and just so that everybody understands, we have two of them. We have two real estate funds. And the reason that we have two is for years, the only people that were really ever allowed to invest in this kind of an investment were what they would consider high net worth accredited investors. That is the Securities and Exchanges rule, not ours. But the SEC said anybody that is an accredited investor can invest in this kind of a vehicle, an investment vehicle. They need to have $1 million in assets, excluding their primary residence, or they need to have annual income of $200,000 a year as an individual, or $300,000 as a married couple. So as you can imagine, that excluded a large portion of the population that is looking to create wealth. And, we follow the rules. We're always compliant, but we always felt like we were doing a disservice to everybody else. Like, first of all, why should they only be able to create wealth when they already have wealth? This should be everybody's own decision to make, not the SEC's decision. So we opened up a second fund about 4 years ago because they changed a lot of those laws. And they said, okay, now you can open up this type of a fund. You can allow unaccredited investors into it, but we're going to limit how much that they can put into your fund. And so we jumped all over that. And so, what we found is we have really, really active clients that are out, boots on the ground, like you said. And I have to disagree with you. I don't think being a real estate investor is a 9 to 5 job. I think it's actually more. Real estate investors are hustlers. You're out and it's a 7-day-a-week job. You are always on call. You're looking for the deals. You're dealing with contractors and tenants. And so we had all these clients that just, really like real estate as an asset to diversify their investment portfolio, but they don't have the time, or they don't have enough money to really get started with real estate. And so we opened up this other fund, not only for unaccredited investors, but for a place for people with smaller dollars. So we actually set our minimum investment at $1,000 because we want to encourage everybody to get started. And we work with a lot of clients, and I think this is really common, that have that old 401k, right? Yeah, I worked at a place three jobs ago, and I don't think I even ever moved that 401k, but don't worry, there's not much money in it. hey, money's money, like get started. So we've been able to assist a lot of those clients to get those types of accounts moved over where they're not taking a distribution on it. They're not going to have tax implications, but they can go set it up with a self-directed custodian and they can start making their decisions on where they want to invest their dollars. So I'm pretty proud of that.
Huge.
Yeah, it is huge. And there are not many real estate funds out there that are what are called a Regulation A+ fund that allow anybody to invest in it. So that was kind of our journey there.
Yeah, no, that's huge because you're right. If you go to, like, let's say a self-directed, oh, okay, great. Hey, maybe I do have money in, an IRA, an old, retirement account or whatever.
Right.
But okay, great. I heard I can use, that money to go, put into investment deals. Yes, you can. But if you go talk to, any, self-directed IRA, let's say to roll that, hey, if you don't have X amount of dollars in that thing, like it's not they won't really even touch it. And so, like, finding an opportunity to be able to go place those funds, because you don't want to cash it out. You're going to get, whacked with taxes and prepayment penalties and all that kind of stuff. Hey, this would be a great opportunity for those, who don't have like massive amounts of capital in there, or maybe they wanted, I want to park some money here. I want to park some money there. Here's a great way for them to go, put it to work, right? So that it is actually, you're right. Hey, that is still money that's sitting there. Grow it. The longer it's not growing, it's
IRAs,
you're losing money.
IRAs and Roth IRAs are probably some of the most powerful investment vehicles right now, from a tax perspective.
Yeah. And then what kind of, obviously, let's say an investor goes to, okay, I've got $5,000, $10,000, whatever, or, $500,000. I'm going to go put it in, to the fund with you. What kind of exposure do I get with that? Like, what kind of projects are you guys, investing in, or what would, markets, all that kind of good stuff?
So what we're investing in is, and our fund is hybrid. So what I mean by that is it's a debt fund and a acquisition fund. So, and the difference is you might go into a syndication, and most syndications are acquisition, right? They're buying an apartment complex, they're buying a self-storage unit, which are great. But ours is probably what I would consider shorter term assets. So we diversify our fund by taking 75% of the balance of the fund, and we create debt. We lend money to other real estate investors. So Steve comes to me, he wants to buy a property, he's buying a distressed property, he's going to rehab and he's going to fix and flip it. We potentially would lend you money to do that. And the way that we secure the money in the fund when we lend that out is we create a lien against that property. So we're not going to lend Steve more than 70% of the value. So we're well positioned with equity in the event we have to foreclose. That's the risk. But again, it is a physical asset that is backing that asset in the fund. So the fund makes money when Steve makes his interest payments every month. Steve is going to pay origination points when we close the loan. So that's a big profit bucket for the fund. And again, that's 75% of the balance. As a fund operator, we didn't want to just rely on one stream of income for the fund, in the event that, things cool off, through COVID, it got pretty quiet with originations, but we don't have lines of credit. We don't rely on Wall Street money. We deploy what we raise. So we were able to still continue to deploy capital through COVID. COVID was good for us, to be really honest. We were one of very few lenders still lending. We had to be very careful, but we were still lending. And we do that nationwide. So we lend all over the United States. We have clearly defined guidelines. Our borrowers have to fit our box, and then potentially we will lend them money. The other 25% of the balance of the fund we hold in acquisitions. So we go and buy real estate in our local market. So we're located in Coeur d'Alene, Idaho, which is northern Idaho. If you're looking at the state of Idaho, we're up at the top, and we lend and we buy in Spokane, Washington. So we have an acquisition team. They find deals for the fund to participate in. We have a contracting crew. If we do have things that require rehab or any kind of improvements, we will send our contracting crew out. We have a property management division. So if we're going to hold that property as a cash flowing property, we manage the property through our property management division. And then we're also a Keller Williams agent. So if the strategy and goal of the acquisition is to actually sell it, we will get it marketed and get it sold. But all those profits go back into the fund, and that's part of the earnings that are paid out to our members of our fund. So we've got interest, we've got origination points, we've got profit from the sale of properties, and then we have cash flow from the rents. And we like having that diversified portfolio essentially because we have different streams of income. So if I know my origination team is having a slow month, I'm going to tell my acquisition people to ramp it up and find some more deals, and vice versa. Like right now, it's winter here. And considering the market, sales of properties are cooling off right now. So we can always ramp up origination. But it's helped us really balance. What I have seen is with everything going on the market, things are starting to shift. A lot of our borrowers, they used to fix and flip. Right now, I see a lot of them holding these properties as rentals. Because you probably know this, Steve, in a downturn market, real estate investors turn into landlords. So we are no different.
If there's more, they are. They pivot.
We are no different, and neither are our borrowers. So we're starting to see that's probably one of the biggest shifts with the debt side of our fund is a lot of these borrowers are holding on to these properties, which is fine. They're great borrowers. They pay great payments. We'll hold that all day long. The other thing on the acquisition side is we're starting to see deals are harder to find right now. And I think what has happened is as rates have gone up, prices are going down, but sellers still aren't convinced that their properties are worth less than they were 6 months ago. And I still think there's going to be some time before they really start coming to terms with that. Also, people have a lot of equity right now. It's different than 2008. People were, in the negative equity position and desperate and in dire straits to sell these. People aren't that way right now. And if they do have a property, they probably have an interest rate on a mortgage from 12 months ago that was half of what it would be now. So, we don't really buy off the MLS market. We buy off market deals. So we're focusing more on like out of state landlords that, maybe have a distressed rental they want to get rid of, out of state homeowners, distressed sellers that, maybe unfortunately they can't afford it anymore. They've lost their job or something like that. So we used to go to auction a lot. The foreclosures were in forbearance through COVID, and I don't know that they fully opened up yet still from that. You still have a lot of people in homes that haven't made payments for 2 years because they've been limping this along. So the biggest challenge with acquisition is finding the right deals. We're not going to overpay considering the marketplace, but I think that's going to change probably come around May or April. But always positioning the fund where we have cash where we can take advantage of those, but we always want to keep cash flow coming into the fund too.
Yeah, no, there's a lot to unpack there. And actually, you're seeing all the same things that I'm seeing, that we're seeing. Of course, real estate's hyper local, but in general, looking kind of at a macro perspective, of course, we're seeing that across the board. Yeah. And you guys are primarily, all your stuff is in Spokane.
All of the acquisitions is in Spokane.
Acquisition, sorry.
Yeah.
The debt is everywhere.
Yeah, the lending is everywhere.
Gotcha. Okay. Okay. No, that's good. And yeah, like I said, it will turn. For those of our listeners would say that this is their first kind of downturn, the sky's falling kind of deal. It's like, well, real estate's cyclical. This is,
right.
This is not the first time this has happened. It's not going to stay like this forever. Just like when the market's on fire, it's also not going to stay like that forever. And this is where, having a diverse portfolio, having diverse investments comes into play, right? Because you want to be invested in solid assets. And, I love that you guys, this is a great way, to be diversified. Something else I see too is, especially for, if you're in a market like I'm in Hawaii, right? And a lot of people don't feel comfortable investing outside of their own backyard. And so it's like, well, this is a great way to have some exposure through a different market. It's like, okay, well, you don't have to be invested in your own backyard. If you don't feel comfortable doing that because it's a super high barrier to entry or whatever, you can still have, an investment backed by real estate that's in a different market that you didn't have to go, buy a house in or buy, their actual real estate. Right. And so, I love how you guys are vertically integrated too. There's multiple profit centers there. You can control different components of the operations, through your management, through your sales. Like having that vertical integration is key. Those are,
right.
That's awesome. Is that something that you guys were had in mind from the get-go, or was that something that's just like, okay, we see a need here, let's fill that hole. We see a need here, let's fill that hole. Like,
it's been an evolution. I think that, you have to look at your rate, your ROI, right? Like, what's the return on our investment? But what we have found is sometimes relying on third parties for certain services like servicing. Like we do all the collection of our notes within our company, and we've tried to outsource that and haven't had a lot of success finding a good servicer. And so we made the investment in software and we brought it in-house because the big key to success on a fund is like knowing what your assets are doing. Like you have got to have a pulse on that. And outsourcing servicing is very difficult. They don't typically do a lot of great collections. They're really just kind of like accounting for payments, but they're not doing a ton of efforts trying to get borrowers to pay. And then, the property management is kind of self-explanatory. Same situation. We outsourced it. It was extremely difficult to get them to lease properties in a timely fashion, to evict people. And we can do it a lot better. So it has been an evolution. We're very organic. We keep a lot, contractors are no different. We're, especially when the market was hot, like trying to get a subcontractor was like an act of God, unless you were doing massive volume. So we're like, we'll just get our contractor's license and we have our own staff. And, if that pipe freezes, I don't have to call a plumber. I send our guy out. So it has evolved over time. And, what I tell people is you can do this yourself, but we have 100 employees. Like it takes a tribe to keep these types of projects going, even the debt side of things, servicing, legal, foreclosing, so why not learn from our mistakes and take advantage of our expertise? And you're still getting pretty much the same returns. I mean, our funds have been paying 8 to 10% historically for 11 years. They've never lost money, so again, like I think you mentioned this, I think a lot of people think it's easier than it is. They watch HGTV. I'm an offender. I thought rehabbing a house, we would be like Chip and Joanna. We were nothing like that. We are still married. We didn't get divorced through it, but it's a lot more work than people think. And you don't have to. Like you can invest small dollars and get the same kind of yields and have zero headaches, travel, get mailbox money, and not have any worries about it. So it's a pretty easy decision, in my opinion, if someone doesn't have the time and the resources to really be active as an investor.
Yeah. No, I fully agree. And that's, I guess it's a great opportunity for people to earn passively, and again, some people are just like, well, I just want to try it. Okay, that's fine. And then like that, just like you said, they think they're going to be Chip and Joanna and, have great hair and it's going to be awesome. And the kids are just running around and it's like, yeah. But you're also likely going to be pulling your hair out and then you're going to have you have rehab overruns, cost overruns, timeline overruns, and if you make any money, or if you gain from it, typically what I would always tell when I used to wholesale professionally when I first started, and it's like, you know what, your first deal, just don't even count on making money. Just count it, just chalk it up to, you got the experience. That is your benefit. And if you don't lose money, then that will be, that's
you're
good.
A win. Yeah, I agree.
So what you're offering is a great way for them to say, look, you know what? Don't deal with the headache. You can go just park it. It will still be in a deal, but you're going to get paid no matter what,
Right.
So
I couldn't agree with you more.
Yeah. Now, if somebody, our listeners, we've got a wide range of listeners. So, some are super active and super hands-on, wholesalers, flippers, deal finders. And then of course, we've got plenty of people who also are more on the passive side, hey, I'm just looking for those returns. I'm looking, I got a great job. I love doing my job. Awesome. I just want to find a place to park capital. Now, somebody, on the, let's say the active side, if they've got a deal, can somebody just bring a deal to you, or
Absolutely.
How does that work?
Yeah. So our lending arm of our company. So if you're a broker or a borrower, so you can broker loans to us, they would go to our website at Kogo Capital, and it's COGO Capital. And that is the lending arm of our company. So like I said, we work with a lot of brokers that bring deals to us. We work directly with borrowers. Essentially, potentially we can lend up to 70% of the value. So a lot of times borrowers can get most of their purchase price in there and their rehab funds, providing the numbers are right. We're not credit score driven. We want to make sure, you have the financial wherewithal to service the debt and get out of the deal. But absolutely. So those would be the more active clients can go to COGO Capital, COGO. On the passive side, if you're, also active, but also looking for something passive, or you're just really like, hey, I don't want to deal with this. I want something passive. Maybe you've got self-directed IRAs, old 401ks. I love, that's kind of like the thing I love talking about is the self-directed accounts. We're not a custodian, but I know a lot about them. And I'd be happy to kind of educate and navigate, on how that process works and what that looks like. But they can go to our website at securedinvestmentcorp.com, and we'll have information on that website about both of our funds, our accredited investor fund and our fund that is open to everybody. And we also sell mortgage notes. So all those loans that we originate through our fund, we sell notes. So we have a lot of clients that are really active and they like it to dig into the deals with notes. We sell our paper also, but that's all on our website at Secured Investment Corp.
Okay, awesome. And then any, let's say for our active people, like any particular deal size, like do you guys, or even, like if we're going to go to you for capital, okay, great. Like, hey, is there a ceiling? Like, are you looking for specific asset class? I know you guys obviously on the acquisition side, you're buying in Spokane, but anything in particular they need to look out for?
Yeah, that's a good question. So we do focus our assets around single family up to 4 units. So we're residential. And I would say as far as like the size, it needs to be under the FHA cap. So we're not going to be the lender to come to for your high-end luxury home on the beach, unless it's under the FHA cap. That's kind of our lane. And commercial, we're not really active with that right now. So anything single family up to 4 units has to be for investment purposes only, and potentially could provide you with purchase price and also rehab funds.
Okay, awesome. And like I said, there's multiple facets there. You guys are obviously handling multiple different types of offerings, both on the fund side, both on the lending side. Right. So yeah, very cool. All right, awesome. Well, at this point of the show, it's kind of the time we transition to what we call our fire round. Is that something you're game for?
I'm ready. Fire my way.
All right. Don't be scared. It's all right. No, it's right. What is the best book that you recommend other than Rich Dad, Poor Dad?
Well, my 2 favorites right now are Atomic Habits, which I think I could read over and over. It's a good reminder. And I'm currently reading Leaders Eat Last. So I have a team that I lead. So I always think it's good to brush up on, leadership skills and things of that nature. So those would be my 2 favorite right now. Very
cool. Yeah. With 100, employees that you guys have, or however many, that's absolutely critical to focus on leadership. So great. That's a great book. Great recommendations. What would you consider as your superpower? What's your superpower?
Oh, I think relationships and transparency. I've been doing this a long time. And when I first got into this, my parents raised me well to be honest. And, I think most people are, but I've always been very transparent with our clients, even if it's bad news, right? Like there is no reason to sugarcoat things. You got to rip the Band-Aid off and address it head on. And I'm extremely transparent with our clients, but I have clients that have been with me for 20 years. And I think the reason for that is I'm very open with them, and I think people understand real estate investing and investing in general is never perfect. Like it's not any riskier than putting your money in the stock market. I think it's actually less because you have a physical asset, the piece of real estate. You invest in a company and they go bankrupt, you have nothing to fall back on. But there's always hiccups. You might have a borrower that doesn't pay. You might have a project that wasn't as profitable as we thought it would. You got to be open and transparent with people, and people understand the risk investing in this type of an investment. But what they really appreciate and what they will continue to come back to you over and over for is your transparency and your honesty with them.
Yeah, no, I agree. That's great. And then what's the biggest lesson that you've learned over your career?
So many.
It's probably a lot. I was going to say, it was just, yeah.
I think the biggest takeaway I've had is really just not leaving your destiny in somebody else's hands. I think so many people work 9-to-5 jobs, assuming that the man's going to take care of them. And that's just not the case. At the end of the day, companies are companies, and, they're going to look out for the best interest of the company. It's not to say that they're out to take advantage of employees, but if you want to create wealth and leave a legacy to your kids, you have to do that yourself, and I feel like we've instilled that in our kids too. We have 2 boys, 24 and 22, and they're both active in real estate. They've had a trash out business. I'm like, you follow your dreams. Our older son just became a full-time fireman. I'm like, that's your dream, but that doesn't mean you can't have side gigs. You're not going to get wealthy and leave a legacy just having a 9-to-5 job. That just is not, in my opinion, not the case. And they're both go-getters. They're scrappers, and you got to work for it. Nobody's going to hand you anything.
No, yeah, that's absolutely right. I mean, it's a different economy now, and just at the pace that everything changes now, it's insane.
I know.
There's so few jobs out there now where you can, I can count on my pension. It's like, there's so, exactly. Right. Yeah. How many underfunded are those out there? What state are you in? Yeah. No, I know. It's so crazy. And then for the busy working professional working towards, financial freedom, what advice do you have?
You got to have good habits and good routines and be disciplined with your money. I think, people get so caught up in keeping up with the Joneses. And, I think, in the past couple of years, capital has been so accessible, even just car loans. And, you have to have your buckets, you have to have your expenses clearly identified, your investment dollars, and, your other, what I call quadrants, and just be disciplined with it. Things come up. Emergencies happen, and you need to be prepared to handle that. But you also need to be prepared financially to take advantage of opportunities, right? I think that's probably the bigger concern is missed opportunities if you don't have access to capital. And, us as an organization, we are well positioned right now, and we haven't even been buying houses for 2 months, waiting. Like we are waiting for this to happen, and we are well positioned in a cash position to take advantage of those. So I think, one, being disciplined for emergencies and investing for the future, but also being well positioned financially so you can get access to capital when those opportunities arise. Because I think that would be my bigger fear is, wow, if there was a great opportunity, I didn't have access to that. That's on me. So
absolutely. Always got to keep some dry powder ready to go.
Yep.
Yeah. No, I got it. And then I know you gave us, your sites earlier, but, if our audience wants to reach out to you or get in touch with you, what's the best routes, the best avenues?
So active investors that are looking to borrow or broker loans, go to Kogo Capital, COGO capital.com. And then for anybody that wants to connect with me from a passive investing perspective, they can go to our website at securedinvestmentcorp.com. They can get information about both of our funds, and all of our mortgage notes are on there, and they can get access to me. They can actually schedule an appointment with me through there. They'll have to put their contact information in there, but I've got a team of 3 other people underneath me, and they're all very well educated about it, and they can talk with me. But, like I said earlier, I'm not a financial advisor. I'm not a tax professional, but we will educate you with what we know and educate you on the opportunities that we offer and answer any additional questions that they might have. And hopefully, they have a takeaway from that.
Awesome. Well, thanks, Heather, so much for coming on to the show today and kind of giving us a little inside perspective on, somebody who's been in the business for just a little bit. Right. And, just the options that we have out there as investors, right? Not everything has to be, so hands-on. There are ways to make money that don't involve us swinging a hammer or, going out and finding the deal, knocking on the doors or whatever. So I really appreciate you coming on, sharing your wisdom, your insight with us. Again, go check out the sites that she has listed. If you've got deal flow or you want to be an investor, you go, if you need that, make sure you're checking out Heather on the sites she gave. All right.
Awesome.
All right, guys. Well, that's going to be it for today. Well, thanks again, Heather, for coming on the show, and I really appreciate you. We'll talk to you soon.
Yeah, thanks for having me. Have a great rest of your day.
Awesome. Well, great show having Heather Dreves on the show. Definitely filling us in on the opportunities available, more on the passive side, but active for those of our listeners that are doing deals actively, need funding for your deals. Make sure that you're hitting her up as well. She can definitely hook you up with some funding for your deals if you've got the right opportunities. And then, of course, if you're looking for passive returns, they can do that through their fund as well. So, but yeah, great having her on the show. Again, thanks so much for tuning in. Please, we would greatly appreciate leaving a 5-star review. Of course, if you found value in the podcast, and if you have anybody you think might benefit from it, please make sure that you're sharing it. Would greatly appreciate that. If you're looking to connect with us and see the deals that we've got going on, of course, check us out on tricityequity.com. Make sure that you're also making plans to attend the second annual Hawaii Millionaire Mindset Conference. That's going to be happening on the Big Island of Hawaii over in the Maunalani Resort. Beautiful, beautiful, beautiful resort. That's going to be happening this summer. So make sure that you staying tuned for that. And of course, if you want to connect with us locally and you're in Honolulu, make sure that you're joining our Facebook group, Honolulu Multifamily and More. We throw monthly networking events. So if you want to mix it up, meet some people who are like-minded, and connect with people on a local level, make sure that you check us out on Facebook. All right, guys, that's going to be it for today. Greatly appreciate you listening in, tuning in, and we'll catch you next time.